Okay, so in this video, we'll be talking about the fifth bi-monthly monetary policy review released by the central bank, that is the RBI. So basically, here we'll be discussing the highlights of the recent MPC meeting, and what they have done is they haven't changed the interest rates in this meeting also. Okay, so the repo rate, that is the rate at which the RBI lends to bank, is also kept constant, that is it is unchanged, and that is at 6.5%. Okay, then the reverse repo rate now the reverse repo rate is the rate at which the RBI borrows money from banks. That is the reverse thing. Okay, and that is also kept constant, and current rate is 6.25%. The cash reserve ratio, the CRR, is also maintained at its original level, that is the 4%. Then marginal standing facility and the bank rate is 6.75%. So just to add to your knowledge, the marginal standing facility is the rate at which the banks can borrow from RBI against some approved government securities. But the difference between this and the other one is that this can be done overnight also. Like in case of emergency or acute cash shortage, MSF rate is being applied. So this rate is obviously higher than the repo rate. Okay, because this is a kind of planned thing and this is just overnight thing. Okay, next is this. Okay, now the difference in this meeting with all the other meetings was that this meeting they had a unanimous vote, that is a 6-member monetary policy committee voted to keep the policy rate unchanged. What happened was in the last meeting plus last to last meeting also, one member was not in favor of keeping the rates at the status quo status. Okay, now they have also maintained the stance of calibrated tightening. Okay, so what does this mean? So this is the rate cut is off the table. They are right now just focusing on controlling the inflation. Okay, now what is the status of SLR? Now SLR is statutory liquidity ratio, wherein it's a ratio wherein the banks have to maintain some minimum balance of their deposits in form of gold, cash, or other government approved securities. Okay, so in this review it was said that it will be reduced by 25 basis point to 19.25%, and which will be effective from January 2019. Okay, now it would be reduced by 25 basis points every quarter till the threshold level of 18% is reached, and this is being done by keeping in mind the issue of liquidity. Okay, the main motive is to infuse liquidity in the system, and this policy move is specially taken into consideration after the recent government and RBI spat. Okay, so this policy will actually allow banks to invest in some riskier appetite such as stock market and other investments, and not in only government securities. Okay, so what is the growth projections? So RBI has made some growth projections wherein it has told that the growth, that is GDP growth rate for the next fiscal will be around 7.5%, and in the current fiscal it will be 7.4%. So it is actually retained the level which was being forecasted earlier also. Now from this instance we can infer that yes, all the macroeconomic variables are doing right, and they have a strengthened position in the market. Plus we can also infer that the investment has increased, and therefore the GDP forecast is on the same level. Okay, this indicates that okay, they have strengthened. Now if we try to look at the inflation projections, we see that the MPC has cut its inflation projection for the next year, and it has pegged around 2.7 to 3.24%. Okay, compared to the earlier inflation rates which are quite high. Now this decision of MPC is consistent. Okay, so this decision is actually consistent with its objective of keeping the inflation around the target of 4%, like under 4% plus minus 2 of bandwidth. Okay, taking into consideration the state of global economy, falling oil prices, crude prices, and the stability of the rupee, we can see that inflation will be quite in control, especially especially seeing the global market conditions. Okay. Now, some projections related to the global economy. So we have seen that in Eurozone is quite affected by the weaker trade growth and the new vehicle emission standards. Plus, in Japanese economy, there's a contraction in especially quarter 3 due to some external reasons and domestic demand. So RBI has actually predicted that these are going to stay, and yes, these are going to affect the domestic economy. Okay. Global financial markets have been driven mainly because of okay, so US, that is Fed rates, are also going to play a huge role here, and volatile crude oil prices, expectations of a slowdown compared with the earlier projections. So yeah, so these are the major factors which are going to affect the domestic economy as well. Yeah, so one more interesting thing which was released in this review was the new interest rate pricing mechanisms. So now RBI has actually asked banks to price all their floating loans according to the external benchmarks. Okay, but the external benchmarks are still to be released, and hopefully they'll be released by the next month. Then RBI has actually, what used to happen was they used to link the prices of these loans to some of the domestic benchmarks, that is the base rate, prime lending rate, or MCLR. But now they are actually asking them to link it with some external benchmarks. They could be anything. They could be the interest rate of 91 days treasury bill or 182 days treasury bill, so on. And still the list is yet to be released. Okay. So in all, this is the summary of MPR. So basically the first one is, yes, they have kept the rates unchanged because they are actually retaining their stance of calibrated tightening. Then 6-member policy, right? Then MPC member Ravindra Dholakia has actually changed his vote to neutral. That is, every time he had a different demand from the group, but now he is actually sticking that the rates should not be changed and inflation has to be targeted. And the committee has lowered its inflation projection, and the GDP estimate for the current year will be 7.4%. Okay, so this is it.